Today's educational video is on building an asymmetric profit trade, and this is probably one of my most intriguing, one of my most favorited types of trades to put together. Asymmetric profit, meaning that the trade that you structure, the trade that you put together, has almost all upside and almost no downside in it. Now that's obviously the panacea. That's what we would want in every trade, but it doesn't happen very frequently. But when it does happen, you need to be aware of it. You need to understand how to structure that. And here in this video, I'm going to show you how we're going to build some asymmetric trades where the profit is much, much greater than any potential loss. And those are called asymmetric trades. A couple of examples that I want to give you here. One of them is the American Express salad oil scandal. And if you really want a good read, you can Google that and immerse yourself in that story, because it was really the launching pad for an individual investor that would later on become known as the Oracle of Omaha, the greatest investor to ever live, Warren Buffett. This was the trade that he credits with launching his success. So the story is quite interesting. In the early 60s, there was a commodities trader named Anthony DeAngelis. And Anthony was an enterprising young man, and he understood that soybeans were a very valuable commodity, and so was salad oil. People don't understand this really about salad oil, but it's just like any other commodity. It's like soybeans, it's like wheat, it's like barley, it's like gold or silver or oil. It is like any other commodity in that it's traded in vast quantities, and there can be some tremendous leverage or tremendous profit in those commodities. Well, he honed in on salad oil. He understood that there was the ability to buy salad oil in one part of the world, ship it to another part of the world, and arbitrage that, profit immensely between the difference in prices around the world. Now, one thing that people don't really understand is that salad oil, again, being just like any other commodity, it's shipped in tankers. It's shipped in tankers just like oil is across the vast oceans of the world to different continents around the world. And so this enterprising young man, he saw that there was a profit potential in salad oil, but he didn't have the money to go finance an operation like that. And so he approached American Express, and they struck a deal. And the deal was that American Express would finance his purchases of salad oil, and then he would resell them, obviously book a profit, pay the loans back, and then the process would start all over again. Now, this process went along quite well for quite a while, until at a certain point, Anthony, being the enterprising young man that he was, figured out that salad oil floats on top of water. And so he started filling his tankers with water and then putting a thin layer of salad oil on top of it. And what would happen is American Express representatives would come to the docks, they would come to the shipping yards, they would go to the tankers, they would put a measuring device down inside of the tanker, and then they would calculate the volume of the tanker, and they would then calculate how much salad oil was in the tanker, and they would cut Anthony a check. And they never really realized that they were really just measuring 90% water. Well, this scandal went on for quite a while, and it eventually blew up. And it absolutely tanked American Express's stock. This was, at the time, in the early 60s, the largest corporate fraud case in the history of the United States. It bankrupted dozens and dozens of companies. It was a $175 million fraud, and it almost sank American Express. The stock dropped from $64 a share down to $38. Now, at that time, no one in the world was interested in American Express's stock. It was considered the worst investment in the world. And a young man at the time named Warren Buffett, who was wealthy. Let's be clear, he was a wealthy man. He was a multi-millionaire at the time. But he wasn't the man that he is today. He was not on the scale, if you will, in the world in terms of wealthy individuals. He probably had maybe 40 or 50 million dollars to his name, which is a lot of money. It's way more money, well, a lot more money than I have, and probably most of us have, but it's a drop in the bucket compared to the wealthy individuals in the world. So he had some money, but he wasn't on the radar in terms of anybody that might potentially become the wealthiest man in the world. Well, he attributes this one trade to building his entire fortune. This one trade is what was able to launch him to success. See, he analyzed American Express at this point. At this time when nobody wanted to touch it with a 10-foot pole, when the stock was absolutely getting crushed, and he said, wait a minute, this is an iconic brand. They have massive profit margins. They almost have a monopoly on what they do at the time, and they've been immensely profitable year over year over year, except for now. And he looked at this salad oil scandal and he says, you know what, this is bad. There's no question that this is bad, but this is a one-off event. This is a one-time occurrence. And they will eventually put this behind them and the fundamentals will come back into place. And this stock will again be a cornerstone for the entire financial community. And so at the time, he took 30 or 40% of his entire net worth. Now, at the time, again, remember, he was wealthy, but he wasn't the man that he was today. Take yourself, for example, and consider taking 30 or 40% of everything that you have and rolling the dice on one particular trade. Now, Warren Buffett didn't look at it as rolling the dice because he saw the asymmetric profit potential of this trade. He basically said, listen, there is no more downside in American Express stock. All of the bad news has been baked in. It's all upside. And what was interesting with this trade was, over the next few years, he absolutely killed it in that trade. It was a 10-bagger. He made 10-fold times his money back. That one trade right there made him $300 or $400 million, and that was enough. That was enough money for him to go out and start Berkshire Hathaway and start diversification and start building his empire. So looking back on his entire life, he looks to this one single trade. And it is interesting for myself as I look at my trades, as a professional trader, as a full-time trader. I trade over 2,000 trades a year. And it is interesting at the end of the year when you're getting ready to look at your taxes, you look back at those 2,000 trades, and in many cases, 60, 70% of your entire year's gain came from 3 or 4 trades because they were asymmetric trades. And so that's what we're looking for, and that's what we obviously want to find. How can you put some money to work with very little risk and tremendous, tremendous upside? Now, the other example I will give you, of course, is the very famous example, much more recent example of Scion Capital. Okay, now Scion Capital was founded and run by a guy named Michael Burry. Now, Michael Burry, that name might ring a bell if you have seen the movie The Big Short. Now, if you've watched the movie, you know the story, but Michael Burry was an interesting fellow. He started a hedge fund in 2000, ran it all the way through 2008, and he absolutely crushed it. He just absolutely crushed it. You can see that his returns, his gross returns, before he charged fees to his hedge fund investors, absolutely crushed the overall stock market. 8% versus a loss. 55% versus a loss, 16% versus a loss. He absolutely just crushed the market. 50% return there versus 28% in the market. He met the market's results right there, beat the market right there, and then 2006 comes along. And Michael started to analyze the mortgage markets. And he saw what no one else really saw. And this was a massive, massive bubble in the real estate market. And that bubble was largely driven by loose underwriting. If you could fog a mirror, you could get a mortgage. People working at the local corner gas station were getting $1 million mortgages just on their signature alone, no credit profile. And he looked at this and he analyzed this and he said, wait a minute, this is a bubble. We are way, way, way overextended in the real estate market. We are way overextended in the mortgage market. And of course, as you know, if you watch the show, The Big Short, he took pretty much every penny that he had in his hedge fund and he shorted the mortgage market. And he was early. He was right, but he was early. And that first year that he did that, while the stock market made a nice, healthy 15% return for the year, for the very first time, his hedge fund lost 18%. As the wagers that he had made on the mortgage market going down didn't work. Real estate kept going up. Mortgages kept getting poured into in terms of investment capital. And for the very first time, he lost money in his return. And as you can imagine, the investors in his hedge fund were not happy individuals. They wanted to pull money out. They were unhappy. There was a lot of clamoring for him to change his investment position. Most people thought that he was crazy at the time. Most investors were saying, listen, there's nothing more solid than real estate. It only goes up every single year. It's the most solid thing you could put your money into. What on earth are you doing? And essentially, Michael Burry just said, listen, this is an asymmetric trade. There is no more downside in shorting the mortgage market. It's already gone higher than it ever possibly should or even probably could. And the only way that this market can now move is to the downside. So there's no more risk left in this trade. It's all simply profit potential. And he stood his ground. He held on to those investments as they continued to lose money. He held on to them. Of course, we know what happened in 2007 when the mortgage market started to absolutely collapse. He brought in a 166% return. He almost brought in a twofold bagger on the investments that he'd made in the mortgage market. Over the 5-year period that he ran his hedge fund, he basically was a 5-bagger return after fees. He brought in almost a 500% net return, almost a 700% gross return before the fees that he charged his investors. He closed his hedge fund in 2008 because he told his investors, listen, I knew what I was doing. I knew it was an asymmetric trade. I knew that there was no more downside in it and that it was all upside, and you guys wouldn't listen to me. I've become a billionaire now by following my own advice. I don't need the hassle of dealing with you anymore. And he closed his hedge fund, gave all of the investment money back to his investors, and said, I'm just going to go manage my own money. I don't need the headaches of dealing with other people's money. So this was another example of an asymmetric trade. And it really is based on an interesting philosophy that has become known as Pascal's Wager. Now, Blaise Pascal was a 17th century French philosopher. He was a theologian. He was an excellent mathematician. And what has, again, become known as Pascal's Wager is right here. Pascal said that belief in a higher power, belief in a God, is a wise wager. He says, granted that faith cannot be proved. Of course, we all know if you have a belief in a higher power, which I do, that's not something that you can scientifically prove, of course. Belief in a God, belief in a higher power is based on faith, right? So he says belief in a higher power is a wise wager. Granted that faith cannot be proved. But what harm will come to you if you gamble on its truth and it proves false? If you gain all. If you lose nothing. Wager then, without hesitation, that he does exist. So basically what Pascal is saying here is everybody should have a strong-held belief that God exists. Because if he does exist, the promises that are made in scriptures are amazing. There is no greater reward that can come to a human being than what is promised to you in scriptures. So you should believe. And if you're wrong, what's the downside? There's no downside in believing that God exists, but there is tremendous upside. So it just makes sense. And it's an interesting thought process. That's what we look for in investing, is the ability to place Pascal Wager type investments. An investment where really there's no downside in the trade. It's only upside. Doesn't mean that it's going to work. It doesn't guarantee you that God exists. But if you are a betting man, that's probably the way you want to bet. So let's take a look at an asymmetric trade or a Pascal Wager type investment and how we structure them here. Let's use an example of just a common stock here. I'll use IBM as an example. Let's say that we think that IBM is a great buy, and I want to go purchase, just for example's sake, just one share of stock. It doesn't really matter how many shares I buy. This is what the risk graph looks like when you purchase a share of any stock. You can see that the POP, the probability of profit on a trade like this, is 50%, and that kind of makes sense, right? See, it doesn't really matter whether we're buying a stock or potentially shorting a stock. The probability of us being right in that decision is 50-50. It's a 50% shot, right? Because it's either going to go up, it's a coin toss really, it's either going to go up or it's going to go down. But you can see that if we are shorting the stock here, we would make money if the stock went down. We would lose money if the stock went up. If we were buying a stock, of course, we would make money if the shares went up, and we would lose money if the shares went down. But it is definitely not asymmetric. It is very symmetric. We have equal risk and equal reward. Now, that's a difficult way to make money. Over time, you have no edge or advantage. And the great CEO Jack Welch of General Electric, one of the individuals that is probably considered the greatest CEO of all time, very famous for saying you have to have an edge, you have to have an advantage in what you do. If you can't find an edge or an advantage, don't go try harder, just walk away. Walk away and go find something else that you can do where you do have an edge, where you do have an advantage. There's no edge, there's no advantage to buying stocks. There's no edge, there's no advantage to shorting stocks. It is a 50-50 shot, and it is symmetric in nature. There's no differentiation between what your profit potential is and what your loss potential is. So what we could do here to make this symmetric trade asymmetric, to where it's really all profit potential and no risk, is change the way that we manage it. And in Tastyworks, there's an interesting feature here. Most brokers will allow you to do this. The mechanics of doing it from broker to broker are a little different. But in Tastyworks, it's very interesting. You just click this bracket button right here. Rather than going here and reviewing the trade and sending the trade and buying that share, I'm going to click the bracket order. Now, I've already set up my defaults inside of my Tastyworks trading account so that they automatically populate at these numbers. But you could do that on your own, or you could manually put these numbers into whatever you want as well. But here are the three orders that are contained inside of a bracket order. So number one is your entry starting point. We say, listen, right now IBM is trading for $124.29. That's my entry order. I'm going to put an order in to buy one share of this stock at $124.29. That's your entry. That's what gets you into the trade. The very minute that this order is triggered and you now own that share of stock, these two orders now kick in and come into play. And they just are sitting there in the background. One is a take profit order, one is a stop loss order. Okay? So this order right here says, listen, I know that we just went in and we bought it at $124.29. I want to exit this trade automatically at a 3% profit. So if IBM touches 128.02, I want you to automatically exit me out of this trade. Okay? Simultaneously, we have a stop loss order going on that says, but if we're wrong and our investment drops from $124.29 down to $123.05, which just happens to correlate to a 1% loss, automatically exit me out of this trade. Now, folks, this is an asymmetric trade. This is a 3-to-1 reward to risk ratio. For every trade like this that we do, we have the potential to make $3 in profit for every $1 that we risk in loss. Now, what does that do? What does that do to our POP, our probability of profit? Well, folks, what it does is it makes it now to where we only need to be right in our trades 25% of the time to not lose money. That's right. If we could just be right 25% of the time, we would not lose any money. If you could be right 30% of the time, meaning if every 10 trades you do, only 3 of the 10 are profitable, you would be immensely profitable. This would be a very, very profitable system if you could trade this successfully only 30% of the time. Now, this is an asymmetric trade, folks. This is a setup that is focused not on profit potential, but on risk management. We have a very, very unique couple of twists that we put on this trade. Number one, in terms of how we select the stocks that we trade. And then number two, a little hedge that we put inside of this trade to add some extra potential to the trade and smooth out the results. So if you're looking forward to our trading systems and how they work and some of the recommendations that we'll be looking at in our trades going forward into the future, remember the asymmetric trade, because this is going to be one of our key focuses. Have a good trading day today, folks. We will talk to all of you soon, and have a great, happy New Year.